Most people picture the transfer of economic power from Britain to the United States as a scene from the Second World War bombed British cities, exhausted imperial finances, and American factories producing ships, aircraft, and weapons on a scale no European country could match. That image is real, but it begins near the end of the story. Long before Britain surrendered its position as the chief organizer of the world economy, the United States had already become the larger industrial power. The puzzle is that the world did not immediately look American. International trade was still financed through London. Sterling still carried extraordinary prestige. British ships, insurers, merchants, and banks still connected continents. By 1914, the industrial crown and the financial throne were no longer in the same country. To understand how America eventually replaced Britain, we first have to understand how that strange division of power became possible. Britain's 19th century supremacy had never rested on factories alone. The mills of Lancashire, the coal fields of Wales, the furnaces of the Midlands, and the shipyards of the Clyde had made Britain the first industrial nation. But industrial leadership created something larger around itself. British merchants developed networks that bought cotton, wheat, tea, rubber, metals, and countless other commodities across the world. British ships carried a large share of that commerce. London insurers protected the cargoes. Merchant banks arranged credit. The Bank of England stood at the center of a monetary system tied to gold, while sterling bills circulated far beyond the boundaries of the empire. A buyer in one country and a seller in another could settle a transaction through a financial claim drawn on London. Britain was not simply producing goods. It was providing the legal, monetary, commercial, and maritime infrastructure through which other countries exchanged them. Across the Atlantic, the United States was assembling a different kind of power. After the Civil War, it possessed a combination few competitors could reproduce: a rapidly expanding population, vast deposits of coal and iron, growing access to petroleum, immense agricultural territory, and a domestic market protected by distance as well as tariffs. European nations often had to cross borders to reach consumers on the scale available within the United States. American producers could sell to cities along the Atlantic, farms in the Midwest, mining settlements in the West, and ports on the Pacific, while remaining inside one political and increasingly integrated economic system. Immigration supplied labor and technical knowledge. Public land policy, private speculation, state support, federal authority, and corporate capital pushed settlement and production outward. None of these forces acted alone. Together, they gave American firms room to expand before they had to depend on foreign markets. The railroad was the steel skeleton of that continental economy. It did more than carry passengers from one town to another. It linked grain elevators to ports, coal mines to furnaces, cattle ranges to slaughterhouses, and factories to consumers thousands of miles away. Standardized time zones, freight schedules, telegraph communication, accounting offices, repair depots, and purchasing departments grew around the tracks. A railroad company had to coordinate men, machinery, fuel, capital, and information across distances that would once have belonged to separate commercial worlds. That challenge encouraged new systems of management. Hierarchies of salaried executives replaced the personal supervision possible in a small workshop. Cost reports and traffic data moved upward. Instructions moved downward. The same organizational methods spread into manufacturing and distribution. American size was becoming more than geography. It was becoming a technology of coordination. Inside the new corporation, scale altered the meaning of industrial competition. Carnegie's steel operations joined raw materials, transport, furnaces, and sales within a tightly controlled system. Standard Oil built power through refining pipelines, transport agreements, distribution, and relentless cost control. Electrical firms connected scientific research to industrial production. Meatpacking companies turned livestock into standardized products moving through refrigerated networks. In 1913, Ford introduced the moving assembly line at Highland Park, but the deeper revolution was already decades old. Products, parts, labor, finance, and information were being reorganized for high-volume production. The American advantage was not that every inventor was American, or every British factory was obsolete. It was that a giant domestic market rewarded methods that reduced unit costs across enormous output. Once those methods matured, the same firms could carry their scale into international competition. The change appears most dramatically in one widely used reconstruction of world manufacturing: Around 1870, Britain accounted for roughly one-third of global manufacturing production, while the United States represented a little less than one-quarter. By 1913, the proportions had almost reversed in spirit. The American share had risen to more than one-third, while Britain's had fallen to roughly one-seventh. Historical estimates differs, and percentages cannot measure every form of economic strength. Yet the direction is unmistakable. Britain's factories continued producing more than before. This was relative decline, not sudden industrial collapse. The problem was that American output was growing much faster. By the eve of the First World War, the United States was no longer merely catching the workshop of the world. In total scale, it had passed it, and yet a steel mill could not perform the work of a banking system. American factories might produce more rails, machinery, oil, or manufactured goods, but international leadership required the ability to finance trade hold, liquid claims, ensure cargo, stabilize payments, and convince strangers that contracts would be honored. London possessed generations of experience in those functions. A British merchant bank did not need to own a mine in South America or a railway in India to influence the movement of capital toward it. Investors trusted London's markets, commercial law information networks, and specialized intermediaries. Sterling's importance reinforced itself. The more traders used bills drawn in sterling, the more banks needed sterling balances. The more balances they held, the easier it became to conduct the next transaction in the same currency. Financial centrality was not a trophy awarded automatically to the country with the largest factory output. It was a network built through repeated use. Britain also held an immense portfolio of investments abroad: railways, government bonds, ports, utilities, plantations, mines, and other enterprises carried British capital into every major region of the world. Estimates vary, but scholars agree that the scale was historically extraordinary. During parts of the period before 1914, British investors sent abroad an amount equal to several percent of national income each year. The return supported Britain's balance of payments and strengthened the City of London. Critics later argued that too much capital had gone overseas when it might have modernized industry at home. But the choice was not obviously irrational. Foreign assets could yield profits, create commercial relationships, and reinforce Britain's geopolitical reach. The very strategy that may have weakened investment in some domestic sectors also prolonged Britain's global financial influence. A mature empire could earn income from ownership and intermediation, even as younger industrial powers expanded production. This is where the argument over British decline becomes more complicated. One school of interpretation emphasizes old equipment, cautious management, fragmented firms, limited technical education, and reluctance to move aggressively into newer industries. Another argues that Britain was adapting rather than simply failing. It remained formidable in shipping, insurance, finance, specialized manufacturing, and international services. Economic historian Stephen Broadberry has shown that the American overtaking cannot be reduced to a simple story of better factories. Changes in services organization and the movement of labor out of agriculture also mattered. The strongest explanation combines these perspectives. Britain still possessed valuable strengths, but its position was increasingly concentrated in the management of a global system. America was developing productive and organizational advantages across a continental economy. Britain's model could remain profitable for years while becoming vulnerable to any shock large enough to disrupt international lending trade and confidence. New York was the obvious candidate to challenge London, but before 1914 it remained an incomplete financial capital. The United States had powerful banks, deep securities markets, and private financiers capable of mobilizing enormous sums. It also had a fragmented banking structure, no permanent central bank, and a currency system that could become dangerously rigid when demand for cash increased. Reserves were scattered through a pyramid of institutions and concentrated in financial centers, while seasonal movements of money could tighten credit across the country. The contradiction was remarkable. The world's largest industrial economy still relied on improvised private action when panic struck. America could organize a corporation spanning a continent more easily than it could organize a reliable national response to a banking crisis. The weakness became impossible to ignore in 1907. Runs on trust companies and disruption in New York's credit markets transformed financial fear into a wider contraction. J.P. Morgan and other bankers assembled private support to contain the panic, but the rescue revealed the problem as clearly as the collapse. A modern industrial nation could not safely depend on one aging financier and a room full of bank presidents whenever confidence disappeared. The crisis accelerated a political struggle over monetary reform. Large banks, small banks, farmers, businesses, regional interests, and elected officials disagreed over who should control any new institution. The result was not a copy of the Bank of England. The Federal Reserve Act, signed in December 1913, created a distinct American compromise, a central governing structure combined with regional reserve banks. It was an institutional beginning, not an instant transfer of financial supremacy. For the people living inside these systems, national progress was less orderly than the graphs suggested. American industrial growth created fortunes, cheaper goods, and new employment, but it also filled mills, mines, rail yards, and slaughterhouses with dangerous work. Immigrants and migrants entered crowded cities where a lost wage could threaten an entire household. Workers confronted long hours, industrial accidents, sudden layoffs, and employers whose economic power could extend through whole communities. In Britain, the contrast took another form. London's banks could finance railways on distant continents, while families in older industrial districts faced pressure from foreign competition, irregular employment, and uncertain wages. The country could remain rich in assets and expertise, while particular towns felt that the future was moving elsewhere. Economic power never changes hands only in government offices. It changes in the distance between the ledger and the street. By the summer of 1914, two different systems stood across the Atlantic. The United States possessed the larger industrial machine, a vast home market, abundant resources, and corporations built for scale. Britain possessed the denser global network, the premier trading currency, the leading financial center, accumulated foreign investments, maritime reach, and institutions trusted to move money between nations. Neither position made the other irrelevant. American factories still operated within a world whose financial language was often British. London's power, meanwhile, depended on a peaceful flow of ships, credit securities, gold, and information that no government completely controlled. Then, Europe went to war. Exchanges, closed trade routes became strategic targets. Governments demanded supplies on a scale private markets had never financed, and Britain began purchasing the products of America's industrial expansion. The industrial crown and the financial throne were about to collide. The First World War did not create America's industrial strength. It revealed what that strength could do when Europe could no longer supply itself. In August 1914, the famous trigger was an assassination, and the visible crisis was military mobilization. But beneath the troop trains and declarations of war, another emergency was unfolding. Stock exchanges closed or restricted activity. Gold movements became politically sensitive. Merchant ships entered seas patrolled by hostile navies. Governments that had trusted private markets to distribute capital suddenly needed to finance armies of millions, while importing food, fuel, metals, chemicals, machinery, and weapons. Britain entered this crisis as the world's leading financial power. The United States entered it as the world's largest industrial economy, but still an international debtor. 4 years later, that relationship had been transformed. Britain initially possessed advantages no other allied power could match. London's banks could raise credit, Britain's merchant fleet could move supplies, and its overseas assets could be sold or pledged to obtain foreign currency. The British government also financed purchases for allies whose access to international markets was weaker. Yet modern industrial war consumed resources faster than 19th century financial prestige could replenish them. Britain could create pounds, but American exporters wanted payment that could be converted into dollars or gold. Every order for American wheat, copper, petroleum, machinery, explosives, or vehicles increased the demand for dollar finance. The empire gave Britain access to manpower and commodities, but it also imposed obligations across several oceans. The country that had once lent capital to build the world now had to draw down that accumulated wealth to keep the world's largest coalition supplied. The shift could be seen at American ports and factory gates. Grain moved from Midwestern farms toward the Atlantic. Steel mills received orders for rail shells and military equipment. Chemical plants expanded. Shipyards, machine tool companies, and manufacturers that had served a continental market began responding to European demand. American neutrality did not mean economic isolation. The Royal Navy's control of Atlantic access made it far easier for Britain and France than for the Central Powers to buy from the United States. That imbalance was strategically important, but it was not evidence that one bank had secretly designed the war. Geography, naval power, creditworthiness, and commercial relationships pushed American trade toward the Allies. The longer the conflict lasted, the more Allied military capacity became linked to American production. Private finance built the first bridge. J.P. Morgan and Company became a central purchasing and financial agent for the British and French governments, coordinating orders and helping arrange credit in the United States. This concentration created controversy. Critics argued that Wall Street had acquired a financial interest in an Allied victory. The concern was not imaginary. Lenders naturally wanted their borrowers to survive and repay them. But financial exposure does not prove that bankers caused American entry into the war. Morgan's power came from a documented commercial relationship created by Allied need not from control over every decision in Washington or London. The more important mechanism was visible. Allied governments ordered goods. American companies produced them. Banks financed the gap between purchase and payment. Each transaction tied the balance sheets on opposite sides of the Atlantic more closely together. When the United States entered the war in April 1917, private dependence was joined by public finance. The recently created Federal Reserve helped the Treasury sell war bonds and provided favorable credit conditions to banks involved in financing them. Liberty loan campaigns brought millions of households into the market for federal debt. Posters presented bond purchases as patriotic service, but behind the imagery stood an institutional transformation. The federal government acquired a greater capacity to tax, borrow, coordinate credit, and direct resources on a national scale. Washington also extended large official credits to Allied governments. The United States was no longer merely the warehouse from which Britain and France purchased supplies. It had become their governmental creditor with claims that would survive long after the soldiers returned home. The balance sheet reversal was extraordinary. One reconstruction estimates that in 1914, American investments abroad totaled about $5 billion, while foreign investments in the United States exceeded $7 billion. The country was therefore a net debtor by more than $2 billion. By 1919, American investments abroad approached $10 billion, while foreign holdings in the United States had fallen to roughly $3 billion. America had become a net creditor by more than $6 billion. These estimates depend on how assets are classified, but the scale and direction are clear. Europe had sold American securities, transferred gold, borrowed from American lenders, and purchased American production. The war did not instantly remove London from global finance. It did something more fundamental. It changed who owed whom. Peace exposed the contradiction created by that transfer. Britain and France had borrowed heavily to fight a coalition war. They had also lent to their own allies. Germany was expected to pay reparations for the damage caused by the conflict. The United States, which had entered later and suffered far less physical destruction, expected its government loans to be repaid. Each position could be defended in national political terms. American officials distinguished commercial or governmental debts from reparations and argued that contracts should be honored. British and French leaders faced taxpayers who had already carried the financial burden of war and populations that believed Germany should pay. Germany confronted obligations imposed on an economy weakened by territorial losses, political upheaval, inflation, and social conflict. The settlement created claims that appeared legitimate when viewed separately but became unstable when combined. Britain made the relationship explicit in the Balfour Note of 1922. The government stated in effect that it would seek from its European debtors and from German reparations no more than was required to meet Britain's own obligations to the United States. The note sounded moderate, but it revealed the circular structure beneath post-war diplomacy. Britain owed Washington. European allies owed Britain. Germany owed the victorious powers. Yet Germany could not easily obtain the foreign currency required for payment unless it exported more than it imported or borrowed abroad. The creditor countries, meanwhile, were reluctant to absorb unlimited imports that might compete with domestic producers. A payment system cannot function through moral claims alone. The debtor must somehow earn or borrow the currency in which the creditor expects to be paid. The Dawes Plan of 1924 reorganized German reparations and opened the way for a new flow of private capital. American money entered Germany through loans to governments, banks, utilities, and businesses. Germany used part of the breathing space to stabilize its currency rebuild industry and make reparation transfers. Britain, France, and other recipients could then use some of those funds to service debts owed to the United States. The system was not a perfectly closed circle, and not every borrowed dollar followed the same route. But its stability depended heavily on continued American lending. Between 1924 and 1929, Germany borrowed billions of dollars abroad, with American investors supplying a substantial share. New credit made old obligations appear manageable without resolving the deeper conflict over trade debt and adjustment. John Maynard Keynes had warned that the post-war settlement demanded too much from a damaged European economy. His argument is often simplified into the claim that reparations alone caused everything that followed. That goes too far. Germany's crises also reflected domestic fiscal choices, political conflict, monetary disorder, and later the global collapse of credit. France had suffered enormous destruction and possessed legitimate security concerns. Britain was attempting to reconcile Allied solidarity, debt repayment, European recovery, and its own commercial interests. The important point was not that one demand automatically produced catastrophe. It was that the settlement connected national obligations without creating a reliable international mechanism for balancing them. Everyone wanted payment. Few governments were willing to accept the import's inflation losses or domestic political costs that successful adjustment might require. Britain's return to the gold standard in 1925 revealed the same tension between international prestige and domestic capacity. The government restored sterling's link to gold at its pre-war parity. To supporters, the decision represented financial normality, contractual honor, and the recovery of London's traditional role. A trusted pound could encourage international business and confirm that Britain remained the responsible center of global finance. But wartime inflation and changes in relative costs had altered the economy beneath the old exchange rate. Restoring the former parity made British goods relatively expensive, unless domestic prices and wages adjusted downward. The burden fell unevenly, especially on export industries already facing intense competition. A policy intended to prove that Britain remained strong required workers and firms in vulnerable sectors to endure the discipline needed to defend that proof. The central bankers trying to preserve the system were not simply blind. Montague Norman at the Bank of England and Benjamin Strong at the Federal Reserve Bank of New York understood that London and New York had become interdependent. They supported cooperation, credit stabilization, and efforts to restore a workable international monetary order. Their decisions remain controversial, particularly the extent to which American monetary policy was influenced by concern for sterling. Yet their dilemma was genuine. Tight credit could protect gold reserves and exchange rates while worsening unemployment. Easier credit could support activity while encouraging speculation or capital outflow. Policies that appeared sensible for one central bank could create pressure elsewhere. Cooperation kept the machinery operating for a time, but it could not eliminate the debts trade imbalances, political constraints, and unequal reserves beneath it. The point at which alternatives still existed was the second half of the 1920s. Creditor countries could have accepted more imports, reduced debt demands, supplied longer-term and better supervised finance, or designed stronger mechanisms for sharing the burden of adjustment. Debtor countries could have pursued more sustainable fiscal and political settlements. Governments could have treated employment and financial stability as objectives equal to the defense of pre-war monetary symbols. None of these choices would have been painless, and no single reform guaranteed success. Instead, the system continued to rely on confident short-term lending, fixed exchange rates, and the belief that temporary credit could bridge structural contradictions. Individually, many decisions were defensible. Collectively, they created a system in which the withdrawal of American capital could destabilize an entire continent. That withdrawal began before the famous crash had completed its work. As American credit tightened and investors became more cautious, borrowers found refinancing harder. The crash of 1929 intensified the reversal, but it was not the whole explanation for the global depression. Under the gold standard, countries facing reserve losses were pressured to raise interest rates, restrict credit, cut spending, or force down wages and prices. These actions might defend a currency's parity, but when several countries followed them together, they contracted trade and demand across the system. Barry Eichengreen and Peter Temin later emphasized that policymakers were constrained not only by gold itself, but by a powerful belief that preserving gold convertibility was the foundation of economic order. The institution designed to guarantee confidence instead transmitted deflation. The damage appeared in human terms long before economists agreed on the model. British miners and factory workers experienced unemployment and pressure on wages, while governments defended sterling's credibility. German workers who had survived wartime shortages and inflation faced renewed insecurity as foreign credit disappeared and businesses failed. American farmers, already suffering from weak prices during much of the 1920s, confronted debt foreclosure and shrinking markets. Bank failures destroyed savings and interrupted ordinary commerce. A family did not experience the international payment system as a diagram of arrows between Washington, Berlin, Paris, and London. It experienced the system when a factory closed, a wage disappeared, a mortgage could not be paid, or a shopkeeper stopped extending credit. Financial architecture became political anger, one household at a time. In September 1931, after intense pressure and a sustained loss of reserves, Britain suspended the gold standard. Sterling did not disappear, and London did not cease to be an international financial center. Leaving gold gave Britain greater monetary flexibility and eventually helped it recover earlier than countries that remained tied to deflationary policies. But the decision marked the failure of the attempt to restore the pre-war monetary order on its old foundations. Charles Kindleberger later described the interwar crisis as a failure of leadership. Britain no longer possessed the resources to stabilize the world economy, while the United States had not fully accepted the responsibilities that accompanied its new strength. Eichengreen's interpretation places more weight on the institutional constraints of gold and failures of coordination. Together, the arguments reveal the deeper transition. Britain could no longer carry the system alone. America had the financial weight to reshape it, but had not yet built or chosen to build a stable replacement. When war returned in 1939, that ambiguity would end. Britain would require American industry and American dollars, not merely to preserve prosperity, but to continue fighting. Britain's victory in the Second World War carried a price hidden beneath the celebrations. The country had survived invasion scares, submarine warfare bombing, and 6 years of mobilization, but it emerged with less freedom to decide how the peace would be financed. Military power had preserved the state. It had not preserved the balance sheet. Britain still possessed an empire, a global navy, experienced diplomats, and a currency used across several continents. Yet maintaining those symbols required imports overseas bases, military spending, and confidence in sterling. The domestic economy supporting them had been damaged. Exports had been disrupted. Foreign assets had been consumed, and debts had multiplied. Britain had won the war it could not have afforded to fight alone. The United States had supplied much of the margin between survival and defeat, and that support would shape who wrote the economic rules after victory. The pressure had begun before America formally entered the war. Britain needed aircraft engines, trucks, machine tools, petroleum, food metals, ammunition, and merchant ships, in quantities its own factories and shipping system could not provide. British officials initially paid through ordinary purchases using gold and dollar reserves, while selling or mobilizing assets held abroad. But industrial warfare was consuming Britain's stored wealth faster than exports could replace it. Pounds could circulate throughout the empire and sterling area, but many essential American suppliers ultimately required dollars. This was the central constraint. Britain could command soldiers, requisition domestic resources, and borrow in its own currency, yet it could not manufacture foreign exchange by decree. Every cargo ordered from the United States exposed the widening difference between Britain's strategic commitments and the hard currency resources available to finance them. Lend-Lease changed the method of payment without erasing that difference in power. Signed into law in March 1941, the program allowed the American government to transfer military supplies and other assistance to countries considered vital to the defense of the United States. For Britain, it was indispensable. It enabled weapons, food, machinery, and services to continue crossing the Atlantic after ordinary cash purchasing had become increasingly difficult. It was not a conventional commercial loan requiring every tank or ration to be repaid in dollars. nor was it an act of charity detached from American interests. Roosevelt's administration believed that keeping Britain in the war strengthened American security. Aid served a strategic purpose, but dependence has consequences even when both sides benefit. Britain could continue fighting because American political authority had replaced the market as the mechanism supplying what Britain could no longer readily purchase. Behind Lend-Lease stood an industrial system operating at a scale Britain could no longer match. American automobile plants were converted to military production. Shipyards launched cargo vessels and warships. Aircraft factories expanded across cities far from enemy bombing. Steel, aluminum, petroleum chemicals, electrical equipment, and agricultural production flowed into a logistics network spanning 2 oceans. The advantage was not simply that the United States possessed more factories. Its factories were connected to a vast domestic market, abundant resources, secure territory, developed transportation, federal borrowing capacity, and corporate organizations experienced in high-volume production. During the First World War, American industry had transformed the country into a creditor. During the Second, it became the material center of an alliance. Production was no longer merely a measure of national wealth. It became the power to determine which armies could move, which populations could eat, and which governments could remain in the war. Britain was not a passive recipient. It supplied intelligence bases, research military experience, imperial resources, and substantial reverse assistance to American forces. British scientists and engineers contributed technologies and knowledge whose value cannot be reduced to a financial ledger. The empire mobilized people and commodities on an enormous scale. Yet these contributions did not remove the underlying asymmetry. Britain's wartime liabilities to overseas territories grew as governments and suppliers accepted sterling claims instead of immediate payment in scarce dollars. These balances helped finance the war, but they represented obligations that would survive it. Victory, therefore, left Britain facing several demands at once: rebuild, damage cities, convert industry back to civilian production, increase exports, maintain employment support, the welfare commitments promised during wartime, service overseas obligations, defend sterling, and preserve the international role expected of a great power. Each aim was understandable. Together, they exceeded the resources immediately available. The contest over the post-war order began before the fighting ended. British and American officials remembered the collapse of the interwar economy, competitive devaluations, exchange controls, debt disputes, trade barriers, unemployment, and the deflationary discipline of gold. Both governments wanted a system that avoided another descent into monetary warfare, but they approached reform from different positions. Britain was a debtor anticipating severe shortages of foreign exchange. The United States was the dominant creditor, the largest industrial producer, and the country most capable of supplying reconstruction finance. The disagreement was therefore not simply between two economic theories. It was a negotiation between a power-seeking room to recover and a power-seeking rules consistent with the resources it would be expected to provide. John Maynard Keynes proposed an international clearing union built around a new international unit called Bondcore. His plan sought to make global adjustment more symmetrical. Countries running persistent deficits would face pressure, but so would countries accumulating excessive surpluses. This mattered because the interwar system had often forced debtors to reduce wages, imports credit, and employment, while creditors could continue accumulating reserves. Keynes wanted a larger pool of international liquidity and more freedom for governments to protect domestic recovery. The proposal reflected economic reasoning, but it also reflected Britain's vulnerability. A system that compelled creditor countries to adjust would reduce the burden on a nation likely to emerge from the war short of dollars and burdened by external claims. Harry Dexter White's American proposal began from a different premise. The United States would supply much of the capital behind any new monetary institution, and American officials expected influence to follow contribution. White also wanted exchange stability and international cooperation, but his design placed tighter limits on the automatic credit available to deficit countries. It relied more heavily on national currencies and on a fund whose resources were determined by member quotas. The disagreement was not a cartoon struggle between British wisdom and American greed. Keynes's plan protected Britain's need for policy space. White's plan protected American resources from open-ended claims and reflected Washington's stronger bargaining position. Both aimed to prevent another depression, Both also carried the national interests of the governments that sponsored them. At Bretton Woods in July 1944, representatives of 44 countries negotiated the framework for the International Monetary Fund and the institution that became the World Bank. The final agreements were not identical to either original plan. They represented compromised technical negotiation and contributions from countries beyond Britain and the United States. Yet the distribution of power was unmistakable. Voting influence was linked substantially to financial quotas, giving the United States the largest voice. Exchange rates would be fixed but adjustable under defined conditions, rather than rigidly attached to the pre-war gold standard. Member countries would contribute resources to a fund intended to assist with temporary balance of payments difficulties. The dollar, supported by America's gold reserves and economic strength, would occupy the central position. International cooperation had been rebuilt, but it was rebuilt around the capabilities of the new creditor. This did not mean that Bretton Woods was simply an American trap. The institutions addressed real failures. Governments gained more policy flexibility than they had possessed under the classical gold standard. Countries facing temporary external pressure could seek assistance rather than immediately forcing the full burden onto wages, prices, and employment. The World Bank was conceived to support reconstruction and development. Exchange rate stability could encourage trade without demanding that every domestic objective be sacrificed to an immovable gold parity. American officials had learned that withdrawing from international responsibility after the First World War had carried costs. They wanted a world in which prosperity, trade, and political stability would support American security. The system served an international purpose. It also ensured that the nation supplying the largest market the most credit, and the principal reserve currency would possess exceptional influence over how that purpose was pursued. The war's end made Britain's weakness more visible, not less. Lend-Lease was terminated soon after Japan's surrender ending, the extraordinary mechanism through which essential supplies had arrived without ordinary dollar payment. Britain still needed imports, but its export industries could not immediately earn enough foreign currency to finance them. Factories required conversion and modernization. Merchant shipping had suffered heavy losses. Households expected relief after years of rationing, yet austerity continued. The government was attempting to establish new social programs while also supporting military forces and imperial responsibilities abroad. Retreating immediately from every commitment might have preserved dollars, but it would also have meant accepting a sharp contraction of British influence. The country was caught between the political expectations of victory and the economic limitations revealed by it. The Anglo-American Financial Agreement offered temporary relief at the price of difficult commitments. The United States extended a credit of $3.75 billion, while Canada provided additional financing. The American loan carried a low interest rate and a long repayment schedule, but it was not simply a generous reward for Britain's wartime sacrifice. The agreement was connected to efforts to reduce discriminatory trade arrangements and eventually make sterling earned through current transactions convertible into dollars. American officials wanted a more open trading and payment system in which goods and currencies could circulate without the restrictions associated with imperial preference, bilateral clearing, and wartime controls. From Washington's perspective, these changes were part of a liberal international order. From London's perspective, they threatened to expose limited dollar reserves to claims accumulated across a sterling system Britain had used to finance the war. Convertibility arrived in July 1947 and failed within weeks. Holders of eligible sterling balances sought dollars more rapidly than Britain could supply them, placing severe pressure on reserves. On August 20th, the government suspended the experiment. The crisis demonstrated that legal commitments could not create economic strength that did not yet exist. Britain had promised greater freedom to exchange sterling, but the world's preference for dollars reflected a practical reality. Dollars purchased American machinery, food, fuel, and other goods that remained urgently needed. Sterling represented claims on a country struggling to rebuild exports while carrying vast short-term liabilities. The pound was still respected and widely used, but confidence in a currency cannot be separated from confidence that it can be exchanged for the goods and reserve assets its holders want. The human price of this transition did not resemble the surrender of an empire in a single ceremony. It appeared in continued food rationing, damaged homes, shortages, export drives, wage restraint, and the fatigue of people who had been told that victory would bring relief British workers were asked to produce more for foreign markets while consuming less at home because exports earned the dollars necessary for imports. Families lived inside an economy where national solvency shaped what could be purchased at the local shop. Across Europe and parts of Asia, Reconstruction was similarly constrained by dollar scarcity. American factories possessed the machinery and materials others needed, but customers required access to American currency or credit to obtain them. The dollar shortage was therefore more than a financial phrase. It described the unequal ability of governments to turn national plans into physical goods. The strongest criticism of America's rise is that Washington used British desperation to dismantle imperial trade protections and impose rules favorable to American commerce. There is evidence for hard bargaining and for the pursuit of national advantage. American policymakers wanted access to markets' limits on discrimination and institutions shaped by the country providing the most resources. But the counter-argument also matters. Britain's old system was not financially sustainable in its wartime form, and no alternative Reconstruction plan could ignore American production and credit. Washington did not invent Britain's destroyed exports overseas liabilities, exhausted reserves, or global military commitments. It inherited leverage from structural conditions created over decades and intensified by war. America's leaders then used that leverage to build a system they believed would promote stability while advancing American interests. Idealism and power were not opposites. They operated together. Britain did not disappear from the world economy. London remained a major financial center. Sterling continued as an international currency. British firms, banks, scientists, administrators, and commercial networks retained influence far beyond the country's size. The empire did not dissolve in 1945, and the full dominance of the dollar developed gradually. But the ability to define the system had shifted. In the 19th century, Britain had connected manufacturing, shipping, insurance, credit, and currency into the first truly global economic order. By the early 20th century, America had overtaken British industrial scale without yet replacing London's financial machinery. The First World War transferred the balance sheet. The interwar crisis exposed the absence of stable leadership. The Second World War concentrated production reserves and lending power in the United States. Bretton Woods transformed that advantage into institutions. So there was no single afternoon when Britain handed America the economic crown. The transfer occurred in railroad yards, steel mills, bond markets, Atlantic convoys, treasury negotiations, central bank reserves, and conference rooms. Britain lost primacy because the obligations of global leadership became larger than the domestic economy that financed them. America gained primacy because industrial-scale strategic security, creditor power, dollar liquidity, and institutional authority finally converged in one country. The familiar story says that America replaced Britain after winning the Second World War. The deeper story is that the war completed a transfer already underway for generations and gave Washington the power not merely to dominate the world economy, but to design the framework through which others would participate in it. If this documentary helped you see that transfer differently, subscribe and leave a like. And in the comments, which factor mattered most? America's industrial scale, Britain's wartime financial exhaustion, or Washington's control over the rules of the post-war system?